Hello, chart watchers, and welcome to this Wednesday, April 3rd, 2019 Market Watchers Live show with your hosts, Tom Bowley and Erin Swinland. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. Well, we've got more gains, more green on the board today. The Dow Jones Industrial Average currently up 94 points. The S&P 500 up nearly 17. The NASDAQ up another 83 points, leading on a relative basis again. Russell 2000 up about 11 points, challenging some overhead resistance from mid-March. 10-year Treasury yield continuing its winning streak. Had a rough March, getting off to a pretty decent start, though, in April, with the yield up about 4 basis points today to 2.52%. Volatility index moving back down and challenging the lows we saw in mid-March. We did go below 13 earlier, but we are sitting at about 13.28 now. Materials having a very strong day today. You can see the last 3 days after making a breakout above this quad top in February and March, we have continued to move higher in materials. Technology also having a very strong day led by semiconductors. The semis are having a tremendous day, breaking out above the highs we saw a couple of weeks ago. Here are 3 stocks that you can see having very, very solid days. AMD, after breaking out above 25, we went back down, tested it, moved back up, and now a huge breakout today, and you can see the volume building here. Micron, after coming out with their strong earnings, went back, tested the 50-day moving average. That one, too, now moving back up and breaking out. And NVIDIA, we've talked about some of the increasing relative strength in NVIDIA of late. Well, it is continuing that today. Also not mentioned here is Intel, which is one of the top performers in the Dow, powering the Dow higher. So semiconductors having a very, very strong day. Okay, Erin, it is Wednesday, hump day. This is day 3 of our week-long anniversary celebration here at StockCharts. For those of you who have not been with us earlier this week, this is 20 years for us here at StockCharts, and we're very proud of it and happy to bring you some special shows. And how are you doing today, Erin?
I am doing fantastic. And I have to say, if anybody hasn't seen the history of StockCharts video that we played on Monday, highly recommend you go to YouTube and check it out. Chip tells you the whole story. It's fascinating.
It is fascinating. And part of that story is here with us today. We've got Gatis Roze. Gatis, how are you doing this morning?
I'm doing fine. I'm frightened to think that 20 years ago, Chip was sitting in my office in Pioneer Square talking about Chip's charts, or I guess what it's called now, stock charts. I was 30 at the time, I think. But it's amazing how 20 years just sort of zip by.
So how did 20 years zip by and you're still 30?
Anti-puberty pills. They're legal in Canada. They're not. I don't think in the States you probably get thrown in jail. But.
Okay, I'll have to talk to Schnell, see if I can get it.
Well, he's 80, and look how good he looks.
Wow, that is amazing. Yeah, I didn't know he was 80.
I'm giving away all these Canadian secrets.
Very cool. Well, I know this is a special week, and when you come back, we're going to bring you back here in about 15 minutes or so. But I do want to start that off a little bit. Maybe you can tell everybody, give everybody just a little bit of background how this whole thing came to be with Gatis and StockCharts. Arthur was telling us a little bit about Chip's charts and how he originally met Chip back on Monday. And so it'd be interesting. I'd like to hear how this all went down. But if you can stick around with us for 15 minutes, we're going to bring you back. So I know you got a presentation for us as well.
Very good.
Sounds good. All right, Erin, lots to do. Why don't we get started here?
All right. The special week is not over yet. We have Martin Pring and John Murphy coming in. We'll be talking to them anyway. I think John Murphy we've got on video. Tom has his workshop coming up on Tuesday, and then Tony Dwyer is going to be our guest on Wednesday. Today, however, we have plenty for you to enjoy. Gatis will give us his presentation, as we noted earlier. I have a video for you. It's going to be a history, pretty much a history of what happened in the stock market in 1999 when we came to be. 10 and 10, first symbol is going to be Zions Bancorp. And we will finish off talking about high volume stocks. And I recommend you go check out the poll as far as that goes. All right, Tom, let's go ahead and get it started. Technical news and headlines.
All right, sounds good. Well, I tell you what, after last month's jobs, everyone's kind of been sitting on pins and needles for this month's jobs. And of course, we haven't seen the non-farm payrolls yet. That's the one everyone really wants to keep an eye on. That comes out on Friday. But today we did get a little bit of a, I don't know, maybe a little bit of a warning about Friday. March ADP employment report came in below expectations, 129,000 versus 165,000. But I'll be honest, I don't know what the market wants. I think maybe the market wants some slow growth. So maybe this is a good number for what the market, because this will keep the Fed somewhat dovish. The market certainly has responded positively today, not only to the economic reports, but to global strength around the world. But we did have a couple other reports come out. March PMI services came in slightly better than expected. March ISM non-manufacturing index came in a little bit below expectations. And all of that resulted in another move higher in the 10-year Treasury yield. Talked yesterday as we were moving up about the possibility that we'd see what happens if we can get up to this 20-day moving average and also back to test this 2.55%. This was a yield support line back from January. We broke below it. So that now becomes yield resistance along with that 20-day moving average. When you get a move to the upside, you can see a lot of times that 20-day will hold underneath. And when you get a move to the downside, you can see the 20 holding as resistance. Can't seem to get through it. So that is the importance here as we move back up. A downtrending 20-day EMA with a yield below it tells us that the yield is moving lower. And of course, that means money is rotating into treasuries. That can be very bearish as the market is more defensive. But a break back to the upside would indicate money rotating away from treasuries. So not only new money coming in to fuel the stock market, but we could have money rotating away from treasuries to help fuel a stock market rise as well. So I think this is a key area to watch, 252 to 255. I think the jobs report will have a lot to do with this on Friday, so we will stay tuned. As far as some earnings news, not a whole lot out, but we did have a couple of reports, as you can see on your screen there. One big negative was GameStop, GME. They missed on their bottom line. They missed on their top line. Did not look good at all. I thought that report was probably the worst of these four. Not only do you see the EPS missing, but they did miss on the top line. They also guided their next quarter's EPS lower and their fiscal year 19 revenues lower. So GME had a really rough report. It had earlier anyway been trying to bounce after a gap down. We'll take a look at that chart here in just a second. But first, let's go in and take a look at Dave & Buster's. So Dave & Buster's in a pretty good space. I mean, you can see the restaurant and bar group continuing to move higher. So far, though, Dave & Buster's, ticker symbol PLAY, hasn't been able to take out that early 2019 high, which is up around $54. So let's watch for that. But we do have some nice volume coming in. I do like yesterday's test of the rising 20-day moving average, which was successful. We've now gapped up and gone higher. But can we take out that $54? That's the level I'll be watching on Dave & Buster's. Let's pull up GME, because GME, there were some warning signs out there. Number one, GME back in January, you can see it had a false breakout above this double top. I never like false breakouts, at least in the short term. That's a little bit of a warning sign. And then we came out with a big move down back in the latter part of January. So on a relative basis, first of all, take a look at what specialty retailers have been doing over the course of 2019. Really nice move to the upside. GME, relative to its peers, has been under a lot of relative pressure. Also, obviously not performing well versus the S&P, while the specialty retail group versus the S&P 500 looks very strong, and at this moment is threatening a major breakout on a relative basis. So GME is not performing well in a very good environment for its industry group. I find that to be extremely bearish for the stock. And yes, we gapped down, but look at where we were 2 months ago, or a little over 2 months ago. We were over 16. Today's open was below 9. We were down almost 50%. This company had lost almost 50% of its value in about 10 weeks. That's a lot of move to the downside. So I think what we're seeing here is a sell on rumor, and then we're getting the news, get the gap down, and now we're coming back with a buy on the news after the news gets released today. I still think GME is something that I would avoid. AYI, this is Acuity Brands, and this is in the furnishings area, I believe. And you can see the move up in the group, taking out prior highs. We're just now making a big breakout on AYI. I want to see if it can close above these multiple tops, because off of this downtrend, it looks like a bottoming head and shoulder pattern to me. Left shoulder, neckline, head, right side of the neckline, right shoulder, almost perfectly symmetrical. And now we're getting the heavy volume potential breakout. Let's see if we hold it into the close. SIG, Signet Jewelry, or Jewelers, did beat on the top line, beat on the bottom line, guided in line. But look at what this company has been doing and got almost no positive reaction, up 52 cents after that, after a beat on the top and bottom line. The overall group, not been great, but it's at least been moving higher. Really haven't seen as much movement to the upside here on Signet. So it's kind of going along for the ride with the group, which is not good because the group has been going down relative to the S&P. So I think we have some problems here. Last one, USNA. They did not report, but they warned. They guided their quarter 1 results lower, quite a bit lower, by the way, 97 cents versus $1.01. 97 cents to $1.01 versus what was anticipated, $1.27. So a huge lowering of their quarter 1 EPS. And revenues, they're expecting revenues to come in at 270 to 273 million. Wall Street was expecting 311 million. Now, if you think technical analysis doesn't matter and you're just simply waiting for fundamental news, take a look at this chart. The group food products was actually making a breakout, although food products has not been performing well versus the S&P. But look at what USNA has been doing relative to the S&P and relative to its peers. And look at the volume that's been coming into the stock on its way down. A lot of folks have been getting out ahead of this report today, ahead of the warning. So if you're not paying attention to the price action, I would highly recommend that you start doing that, because these charts, especially these relative charts, tell us a story. And if you're not following the story and you're just simply waiting for a recap at the end, probably going to end up losing a lot of money. So anyway, USNA came out with a warning, but the warning was already in the chart. So we shouldn't be surprised by what has happened. A couple things to mention before we get into upgrades and downgrades. First of all, we've seen a really strong move in materials today, but I do just want to caution you that since October of 2017, we have been in a downtrend. The material stocks versus the S&P 500. And it's really important that when you see that, you understand that during that same time frame, or roughly the same time frame, the dollar index has been rising. When you've got a rising dollar, we tend to see underperformance by materials and energy. So yes, we are currently rising on a relative basis, and we've done that a bunch over the past 18 months. But each time we rise, we go back down to lower lows. So just be careful. You can see we're sideways consolidating. If I pull up that dollar chart, well, the dollar's been sideways consolidating for the last 5 months. So that is what's creating this back and forth action on materials. If the dollar breaks down and we get a breakout on the XLB on a relative basis, that would be wonderful. I would not just assume that that's going to happen. As far as some other areas of the market, we do have the semiconductors, as I mentioned earlier, really making a huge breakout here. A couple of stocks. I mean, you've got Intel making a nice breakout. How about AMD? Look at the volume coming into AMD, over 100 million shares already today, making another huge breakout. It's been trading in very bullish fashion, holding price support and its rising 20-day moving average. And then even some of the stocks that had not been performing well, Micron, which had been on a long extended decline, came back up, sideways consolidated. I see equal highs, rising lows, ascending triangle breakout here. NVIDIA, oops, wrong ticker. NVIDIA also showing a lot more increasing strength, relative strength. Got a little bit more work to do once it gets up here to gap resistance just above 200, but looking very good. And one final on Applied Materials. Also, after moving up, sideways consolidating, making another breakout. Volume seems to be picking up here as well. Okay, upgrades, downgrades. Erin, what do you have for today?
All right, let's take a look at a few. I'm going to start off with Canadian Natural Resources. Let's see here. Okay. Canadian Natural Resources was upgraded today by Evercore from an inline to an outperform. You know, the PMO has been moving mostly flat, as has price, but I do see a possible symmetrical triangle. Certainly, you could maybe even make a case for an ascending triangle. So I think, an ascending triangle, and that is bullish. And the other thing I noticed, of course, was when I was drawing this declining tops trend line, it matches up pretty much perfectly with the 200-day EMA. So, if I could see a breakout of that EMA above that, and then see if this PMO can follow through and get that buy signal again, I think there's some possibilities here. Obviously, Evercore seems to think so. All right, next up is Intellisat Global. They were upgraded today by JP Morgan from a neutral to an overweight. Current target is $27. So right about here at the overhead resistance is what they're looking for. I like the look of this. You had a bearish pattern, a descending triangle, and instead of breaking down, it was able to hold that support and now is broken out to the upside. I've got a PMO that's scooping nicely to the upside, so I like that as well. I think this could be an interesting short-term play. I don't know where we might get with it as far as an intermediate-term play, just because we do have this overhead resistance here at this low I see back here in December. But overall, the stock's looking pretty good. Next one up, Urban Outfitters, and they were upgraded today by D.A. Davidson from a neutral to a buy. And Davidson also raised their price target from $30 to $36. So currently it's trading at almost 32. Makes sense that they would raise that guidance there. As you can see, we have the descending wedge. That is a bullish pattern, and this has been in play and forming since really December. And it's just continued on down. The only problem is, of course, is the setup of these EMAs. Don't like it. Your 50 is well below the 200. But right now, with that nice breakout from that wedge, it's now overcome overhead resistance at both the 20 and 50. They're both starting to turn up. So, I think there is some pretty good upside potential here. I mean, the PMO is looking pretty good, and volume definitely is coming in behind this rally to the upside. All right, let's look at a few of the downgrades. Caterpillar was downgraded today by Deutsche Bank, and they went from a buy to a hold, moved their target from 152 down to 128. So a pretty serious downgrade here. We had that descending wedge, got the breakout. I think that looked great, but then you ended up at that overhead resistance area and it just couldn't break through it and is now starting to turn down. However, I think there's still some possibilities here based on the PMO buy signal that came in. Of course, it came in after this sharp move to the upside. It's not something I would certainly jump into until I could see that overhead resistance could be overcome. Coming off of a nice strong rally there, it's unfortunate didn't manage to get that breakout. Next up is going to be Insight. And I know we get this as a request for 10 and 10 a lot. It's in a trading range here. They were downgraded by RBC Capital from an outperform to a sector perform, and they've moved their price target to $89. So it's a move to neutral. We're not looking at anything as far as the downgrade is concerned. I don't think they're not really looking for it to descend, just not to perform. And I would have to agree. You've got a PMO that's still declining. I would like to see that turn up. You've got pretty decent OBV. And of course, Scooter looks pretty good. But at this point, I wouldn't expect Insight to, crash on you. But it is a biotech, so anything is possible, as Tom usually will say. And you can see the strongest area of support is at $75. So risk is there. Suncor Energy, Evercore upgraded from outperform to in line. It managed to avoid the execution of a possible double top here. Got down to support, held it, and has broken out. But now we hit that 20-day EMA, and it's turning back down. And the PMO is starting to accelerate a little bit down at this point as well. So Suncor not looking too good. All right, that is the upgrades and downgrades here, the ones that I went over. A couple of others in the mix there that you might be interested in would be, as far as downgrades, Chubb, CSX, Raytheon were also downgraded today, as well as Dow DuPont. All right, time to bring in Mr. Gatis Rose. And welcome back. We're really glad you could be here during our special anniversary week. I'm really looking forward to this presentation, and I do want to hear a little bit about how you joined StockCharts as well. So shall we get started?
Good morning, everyone. We're actually doing some clicking here to get the screens up. I feel very, very intimidated because I feel like Tom and Erin are like Peter Jennings and Jane Pauley, and here I am, just this rookie that gets in front of you every 6 months or so. But anyway, I do have an interesting story to sort of set the landscape 20 years ago when I had left Silicon Valley, retired up here, and I was running a users group for a boxed software technical analysis user group, which will go unnamed. And at the time, the boxed software had over 100,000 users, and our user group here in Seattle was over 100 people. And for those of you that have no idea what boxed software is, you had to download your own data and manipulate your own data and correct your own data, and it was a pain in the derriere. It's interesting that within that 2 years, that 90% of the group had migrated to StockCharts.com. So even 18, 19, 20 years ago, it was a disruptive technology. StockCharts and Chip brought to the market a really disruptive technology, and it's been great ever since. It's been a great ride. So that's my little story. I'm sort of looking back over the last 20 years or so. I thought what I would bring to share with you today is sort of the tools and a few little tricks that I feel are really powerful, and everybody should look at them. So I'm just going to sort of breeze through a couple things, and one of them is seasonality. For those of you that know me, you know I'm a probability junkie, and so I'm going to start off with, I wrote a blog back in December 2013, and I picked in that blog, the blog was called Some Seasonality Goodies for You to Unwrap. This is my Trader's Journal blog. I presented 6 stocks that had alluring seasonality attributes. And all I did was track them for 6 weeks. And then I wrote another blog about them, how they had done. And we had, these 6 had outperformed the market by 150%. So take a look at the blog I mentioned, and I'll present some other stocks here. So you don't feel I'm sort of cherry picking. I just picked a few stocks out of the Dow. So these are 30 stocks, I'm not presenting 30, but here are examples from Dow stocks. Look at the seasonality here, and I picked 5 years. You know, with seasonality, you can do 10 years, 15 years, whatever you like. But this is just straight statistical data. And you can see that BA has outperformed 100% of the time over the last 5 years. It's been up in July and October, and some very nice gains, if you will. And you'll see in August it's never been up. The same with Microsoft. You can see that July and November have been historically very strong. June very weak. The same with Coca-Cola. And these are large companies, so to think that it's sort of counterintuitive to think that there's seasonality involved in these large companies, but you can really take advantage of this. There are trading systems out there that do, but the big advantage I feel is for portfolio rebalancing. Here we're looking at a sector, and people would say, well, the sectors, that they probably don't have much seasonality because they're so diversified. Well, here's XLF, here's XLK. Look at the seasonality. So why not take advantage of those and buy in weak months, sell in strong months? Put the probabilities on your side. Anyway, so I challenge you to take a look at using seasonality. It's a wonderful indicator. Another thing that I'd like to talk to you about is this is a chart list from our chart pack. Many people don't think of StockCharts.com as a source for economic fundamental data. I'm a big believer, and I know I've been preaching for years something called rational analysis, where you combine the fundamentals and technicals so you get the best of both worlds. Here's an example of a chart list that we have in our chart pack that looks at a lot of different fundamental data and allows you to, and I want to make sure that the listeners are aware that this is available. This sort of data is available on stock charts. For example, here's an example of unemployment rate. And if you look at it, it's actually a leading indicator, looking back to 2000 back here, that the market continued to head up while unemployment here started to tick up. Back here as well, unemployment led. The market continued to go higher. So when I see downtrends like this in the unemployment rate, it makes me feel more comfortable sitting in the market. This is the same sort of thing. Industrial production, you can see that this is a long-term chart looking at 2000. So we had a little blip here, but industrial production continues to look very, very attractive. So from a fundamental standpoint, I'm willing to hang in there in the market. This is another example of combining, again, what I'm calling rational analysis, combining the best of technicals and fundamentals. This is the S&P 500, and it's showing you the actual composite, but it's showing you here, this is the PE, and you can see that the PE actually over quite a long time has been declining. Well, why is it declining? Clearly because earnings have not only continued to accelerate and trend up, but have been very, very, very strong. So I would suggest submit to you that take a look at a long-term chart of this, and you'll see that the market is really driven by earnings, and so you can feel sort of rest assured using that fundamental data to sort of hang in there. This is another example of, down below we have fundamental data such as dividends. This is a mutual fund. I've owned this for a long time. My point here is when you plot the dividends, you can see that T. Rowe Price pays out capital gains every December 15th or so. My point is, do not buy a mutual fund on December 10th, just before they're going to pay out distributions and capital gains. So here's some examples that I had for you about using combining technicals with fundamentals. The other part that I look at this every day, this is the predefined scans on stock charts, and I use it a little bit differently than many people. I find this to be a breadth indicator, looking at 52-week highs, looking at how many strong gainers, even down here looking at improving Chaikin money flow. Those are looking for hot stocks as well. I find that to be a very powerful breadth indicator, build my intuition. If I scroll down here, these point and figure patterns are absolutely fabulous. And I like to look at things like, for example, here we see that there are 26 NYSE stock and 10 and 26 NYSE, 10 NASDAQ stocks that are breaking out from a triple top breakout, or looking at something like a quadruple top breakout. So what you get there are stocks that look like this. You can see here that it tried to make a new high, pull back, tried to make a new high again, went through, then pulled back, consolidated here. Now it's making a true high. And this is a major stock because this is Hershey. These are the kinds of stocks that you would find in those breakouts. You can see Kimberly-Clark. It's been going sideways here in a range, and it breaks out very nicely. You can see, look down below, you can see on balance volume again, supporting that move. Also, here's a realty equity company. You can see how this scanning engine produced this and had me start looking at it sideways, pull back, look at the on balance volume as well, looks very attractive. So I would really encourage you to, I know some of you want to write custom scans, that's perfectly fine, but don't ignore the predefined scans. They're very, very powerful. Here's another one, Grace Company. You can see the same thing, went sideways, had a pullback, and now it's broken out into a new high. And that's those scanning engines are where you can get these stocks. Another tool which I think is often overlooked by many users is the perf chart. And there are a couple of ways to do this. I'm going to use this as an example of looking at healthcare. So what I've done here is I have two indexes, the S&P and the Dow, and then I have two ETFs, and then I have two mutual funds. So what I'm looking for here is healthcare worthy of sort of a long-term investment? That's one question, and that's answered very clearly because you have both mutual funds and both healthcare above. You see here, these are your S&P index and your Dow. The second question I want to answer is, these are both ETFs. Well, can I find mutual funds, and these are two T. Rowe Price and a Janus mutual fund, that outperform not just the market, but outperform the ETFs? In other words, I'm willing to pay these guys their fees because they're clearly worth their money. So you'll see a little bit more of this later, but that's one way to use a perf chart. Another way, this is a blog that I wrote last year. And what was interesting, I have 20 asset classes that I invest in. One of them I invest directly, large cap stocks. I buy Visa and Microsoft and Amazon and that sort of thing. But on the other 19, it was interesting to, I maintain these charts called best of breed charts, where I'm looking at, I load on them. Green is always VTI, which is the Vanguard Total Stock Market Index. That's my bogey. The black line is whatever here is at the top. So this is JKG is a mid-cap ETF. And then you have a number, you can see here, these are a number of other options, whether ETFs or mutual funds. And then you have this orange line, which happens to be the prime cap Odyssey Aggressive Growth Mid-Cap Fund. So I maintain this chart for mid-caps. So I'm looking, when people come to me, let's say in one of my classes, and say, have you looked at this ETF or have you looked at this mutual fund? I can very quickly throw it on the chart, compare it to the market, and you can see I've owned prime cap for a long time. Why? Because it outperforms the market, it outperforms the ETFs, and I choose to do mid caps using this mutual fund. That's not true in every one of the other asset classes. Is biotech for me. Well, I've done the same thing, loading the best mutual funds, loading Vanguard, VTI on there, and XBI, which is the black line, which is my choice of investing in biotech, is an ETF. It's a basket of ETFs. So you can see here, these are what I call best of breed charts. Here again, this is your sort of allocation fund that has stocks and bonds, and you can see where the market is. You can see what the sister options are, and I've owned T. Rowe Price for a very long time. Why? Because it outperforms. So I'm willing to pay them their fees. Here's another example. In the emerging markets, my preference is IEMG, which is an ETF. So the point of this blog was simply that 50% of my asset classes are ETFs. The other 50% are mutual funds, but you need to make that decision yourself. Here's just another focus on that particular chart that I showed you in the blog. And I maintain these so I can, I update them regularly. Anyway, we're moving on now to another thing I would like to show you. This is a chart, obviously, of all the sectors. And in this case, we're looking at it over the last 50 days arbitrarily. Technology is clearly outperforming. So if we go to the homepage, this is a free tool. This blows me away because it's a free tool. We know now we're looking at, let's say, 1 month. So we look at 1 month and we can see that the technology is the most attractive. So let's click on technology. Then we see all the industry groups that make up the technology sector. We see computer hardware. Well, let's click on computer hardware. We see all the top stocks in that industry group under the sector of technology. So we click on IntelliCheck, and we see that it's a very strong breaking out chart. Now, follow this along. If you, under chart styles, if you pull down my name, and you'll get this pre-formatted chart. It comes up very easy. So here you've now gotten a stock which is outperforming the market because it's relative to VTI. It's in the strongest sector, you see, because it's a technology sector. And you can see that the industry group within the technology sector is starting to perform nicely and trend up. And now you've got the strongest stock in the strongest industry in an uptrending in the strongest sector. So it's all easily on one chart, and then below you see on balance volume as well. So this is a very powerful tool, I feel, and StockCharts has made it very easy to do that. As I mentioned, you could see, you just click through it. On the flip side, this was a blog I wrote, and I did a whole series of these practice. I call them action practice, where I give you a challenge 1 week and then a couple weeks later. But you can see that the same thing works on the sell side. Here we have Coeur d'Alene, and you can see that it starts to underperform the market. The sector is starting to fade. The industry group is starting to fade, and Coeur d'Alene, which had been a very, very strong stock, starts to underperform its brothers and sisters. So when all of those four align, it's sort of a reasonable time to take money off the table. So it works on the other side of on the sell side as well. Here's dry ships. You can see it starts to underperform the market. It starts the sector's fading here. The industry group is flattened out, and then dry ships itself is underperforming its brothers and sisters. Ironically enough, you've got a triple top going on there too. So the same thing with First Solar, GNC. But my point is, you can go and look at that blog yourself and see that it actually it does work on this relative strength approach. Works on the sell side as well. If you had used this approach on GE, for example, you would have gotten out very nicely. Here's a long-term, couple years, 3 years. And you can see there were a lot of warnings. Even as GE was making higher highs, you can see it was starting to underperform the market. Its sector was trending down here, and then its industry group was trending down, and it was flat. So it really does work on both sides, on the buy and the sell side. Another trick or tool, if you will, that I think is the closest thing we have to the Holy Grail is something that Joe Granville invented it using it on balance volume, used it for end of day data. In other words, he would say that if the market was up, he would take all that volume and put it in the bucket, so to speak, in this, think of this as a bucket on balance volume. And then in the next day, if the market was down, he would take all that volume out of the bucket. So the bucket was either rising or falling based upon the amount of volume that was going into it. Chaikin came along and refined that a bit. But my point here is, now that we have 1 minute volume available to us, and it's free. I just can't believe this. Here's an example of how that works. That we have a situation here, audio codes, and you can see that it's going as it goes up here. On balance volume is showing that it's under accumulation. It has a pullback, but on balance volume doesn't show distribution. Then it starts to head up, and it very clearly is under serious accumulation. And this is, believe it or not, this is 1 minute data here, all compressed. The most that you can put on stock charts is 20 days. In this case, I put on 12. But I would really encourage you to play with this 1 minute data, because it's just it's truly a wonderful tool. Here's another example where we have a stock that's going sideways, but is still, you can see very clearly it's being accumulated here, obviously being accumulated. And then you have this big pullback, but you don't have a lot of distribution. And then once again, you've got this confirmation going on with the 1 minute data. So as I say, I use this on one of my screens when I'm actively buying and selling, and I'm looking just at 1 day at a time. It's very, very, very powerful. I've saved these all, so I have to find my spot again where I am with the particular charts. Here's an example of a chart where it's almost like having X-ray vision. The price is going up, 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 but notice what's happening on the on-balance volume. This is being distributed. So Mr. Fidelity, or Mr. Market, as Wyckoff would say, or the composite operator here, is actually distributing stock, not accumulating stock. Another example here is a stock, VUZI. You can see here that it's going sideways price-wise, but on balance volume says, no, it's being distributed. And so down she goes. I would really encourage you to look at this. I wish I could pull up Facebook. Unfortunately, they don't archive these things back very far. But when Facebook was hitting a new high, it was shocking to see that it was actually being distributed. So as Facebook was making a new high back there in July, the on-balance volume was showing, no, it's actually being distributed. So it's a very powerful tool. So I just wanted to share a couple of those things that sort of my favorites from sort of 20 years greatest hits. I know I went very quickly, but I didn't want to run over time.
Gatis?
Yes, sir.
First of all, I'm a huge proponent of seasonality, and I know you started off with seasonality, so I really enjoyed that. I don't know if you had looked at a couple of stocks, one being Booking Holdings, BKNG, and on the seasonality.
And you can see the seasonality button is right at the very bottom. So, Tom, home run.
If you could stretch that chart back, if you can grab that slider and go back 20 years from 5. Yeah, and what I was looking at, one of the things I always find very interesting about this chart is look at the performance of Booking in the first 4 or 5 months of the year in terms of their average return. I mean, it is unbelievable heading into spring. And then if you look at the rest of the year, it basically is flat if you combine all the rest of the years. And you can see on a percentage basis, February, March, and April tend to go up most years, 80% February, 75% March and April. And when you just look at that and compare it to the rest of the chart, it is, really unbelievable. Now, they did come out this year and earlier this year, and I think they missed on their earnings. So that they had a rough start, or at least in February, they had a really tough time at the end of the month. But they're starting to come back. And I noticed today it was trading at about a 6-week high. And this is a stock that tends to do very well this time of the year. As you can see there on the last 5 years you pulled up, in April, it's been up each of the last 5 years. We're in April and it's making a breakout. I think some of the seasonality information is overlooked here. I think it's a powerful tool at StockCharts.
The checks in the mail, Tom. This is a probability enhancement that everybody should be looking at. As I say, I know for a fact there are algorithmic trading programs based on this back in New York. This is a freebie, guys. This just puts the probabilities, and from a portfolio rebalancing standpoint, why would you not sell, for example, if you have too much of it, this has grown too much, why not sell it in March and April? And if you're replacing it with something else that has seasonality, why not buy that on weakness? So you're selling into strength and buying on weakness. From a portfolio management rebalancing standpoint, it's just a very, very powerful tool. I can't speak highly enough about that. But so yes, thank you, Tom, for that comment. I had one last little section. I feel very, very I feel very strongly that a big part of being a successful investor is just your organization. And so in this case, what I'm actually using is an old chart pack, that a layout to show you an old chart pack that we have here. But organization is sort of the big picture, the roadmap that you follow, and your routines, or these checklists. It's sort of an inventory. These chart lists are sort of an inventory of the program, the agenda that you're going to follow. And so that you can replicate consistently. You're not a bumper card that's sort of bumping across the entire market. That when you win, you understand why you won, and you've got an organizational approach to do that. And the fourth leg is sort of having I love this old quote by the Dalai Lama that said, "A disciplined mind leads to happiness, and an undisciplined mind leads to suffering." The cliche here is, you got to do what you have to do before you can do what you want to do. And these stock charts offers you the ability to organize these chart lists in really fabulous ways. Whether you, as I say, we have this, Grace and I keep this up, this chart pack that you can download, but you can see that the top, there are a bunch of permission to buy slides, which is really essential. There are a bunch of dashboard items. I showed you some of those. There are all these different chart styles that we use. They're indexes, they're interest sensitive stuff. There's a lot of focus here on sectors. And then we move into we're big proponents of using the Fidelity sector funds to help us understand what's happening in the sector arena. And then just looking at, for example, here, looking at all the Dow industry groups. They're all downloaded, and you can sort them different ways. It's just organization is not to be sort of overlooked. So that was really the last of my points. I guess I had there's the StockCharts store. You can go and dig into the chart pack if you're interested in. And then have to pitch my book. Grace and I wrote this book that's been selling very nicely. It's all the 10 stages are there. And then my last slide is whenever Grayson and I teach a class or whatever, we have our own website called Stock Market Mastery, and it talks about it has all the 10 stages, for example, from the book, and describes it. So it if you're interested, feel free. And if, of course, always the Trader's Journal, which comes out. Here's the 20th anniversary blog that's just talking about today's show. So,
well, excellent. There were a couple of questions, Gatis. One question was, how do you put the PE on your charts? I know you had a couple charts there showing the PEs and looking at the S&P 500. How do you get those on your charts?
Let's see. Then we have to go back to for those of you that have the chart pack, it is in this GR 10.4 where we call it our dashboard. We have 16 long-term indicators. I showed you unemployment. I showed you industrial. Here's the graph for that. So you can see these are just straight symbols from StockCharts.
Okay, so they can come back, look at the recording, and look at your set down there.
But you can see here that the S&P earnings is available to you, and that was my point of showing you this slide. These are available. These are fundamentals that are available through StockCharts. So it's not. It's really powerful when you take fundamental data and chart it, which is what we've. I think this is a powerful chart, which gives me confidence. I mean, those are earnings, guys. Those are the S&P 500 earnings. They're pretty damn attractive, and the PE's going down, and so I'm not nervous about this market. And I wasn't even amongst this pretty serious pullback that we had.
Well, I was a little nervous on the pullback, but
I know I'm overstating it. I went to the anyway. Yes, I was.
I have to say I was a little bit nervous, but I did think that it was a cyclical bear market as opposed to a secular bear, which I think is a huge difference.
Mm-hmm.
My point with this dashboard that we call, it just gives you the confidence to either, I'm not saying you have to stay 100% invested, but not to be, the world's flat, got to jump off the edge kind of thing. The world's ending. It gave you the confidence to say, yes, we're having a pullback, but I'm not going to take all my money off the table and go to cash. That's the benefit of having all these charts of economic data. I think it's very powerful. And as I say, charts like this that I showed you before with the unemployment, take this chart for those of you that have pro accounts that can go back, 30, 40, 50 years. It hasn't been wrong. And as I pointed out here, when unemployment starts to change trend from downtrend to uptrend, the market still continues to go up. So it's a leading indicator here, and the trend hasn't changed, has it? I think any 10-year-old would tell you unemployment's in a downtrend. So very good.
Yep. And there was a question about how you get some of these economic charts. I know if you put into the Sharp chart, if you just type in $, it'll give you a list of possible economic reports.
Yeah, this coming up with the symbols is there are a lot of symbols on there. So it's just a matter of going to. I mean, you can see all of these things in charts. As I say, if you download the chart pack, it's all there pre-formatted for you. But if you don't have $49, then you have to figure out how to do it yourself.
All right, well, it was a pleasure to have you on here today, and thank you so much for being part of the special week with us. Hopefully you're not going to wait for the 40th anniversary to come back and join us.
No, I would like to book that now, please.
If
All right.
you're
I may
able,
run out of anti-puberty pills by then. So, I really would.
if you're able to, Gatis, it'd be great if you could just share, send me one or two of those charts and I can put them in the Market Watchers Live recap for tonight.
Very good.
Yep.
Okay.
Okay. Thank you, Gatis, so much.
Thanks for having me. Thanks so much.
All right, guys, in celebration of StockCharts' 20th anniversary, Monday we heard from Chip on the history of StockCharts. Yesterday, Tom looked at the major events of 1999. And today, I want to share with you a look back at the stock market in 1999, the year that StockCharts was established. So enjoy. Just a few days before the launch of StockCharts.com, the Dow Jones Industrial Average closed above 10,000 for the first time in its history. 5 weeks later, the Dow Jones pierced 11,000. Meanwhile, the NASDAQ Composite posted its best ever annual return of 85.59% in 1999. Then popped another 25% in the first 2 months of 2000 before the dot-com-led bear market settled in. Economically, unemployment rates reached their lowest levels in 30 years, and for the second straight year, the federal government operated at a budget surplus, following 3 decades of deficits. Interest rates were on the rise as the Federal Reserve raised the Fed funds rate on 3 separate occasions to battle a rapidly rising GDP, which reached 4.8% in 1999, the highest level since 1984. The Fed funds rate ended 1999 at 5.5%, more than twice the 2.5% level where it stands 20 years later. The year's gains occurred as the U.S. economy was poised to record the longest expansion in history. A lot of the market's records were set in 1999. Here's a few examples. The NASDAQ Composite rose 85.6%, the biggest annual gain for a major market index in U.S. history. The Dow Jones Industrials gained 25.2% in 1999, a record 5th year in a row that the blue chip index posted a double-digit percentage gain. The S&P 500 rose 19.5%, a record 5th straight year the index posted a double-digit gain. A record 203.9 billion shares were traded on the New York Stock Exchange, and a record 265.6 billion shares changed hands on the NASDAQ. But despite the headlines about records, analysts noted the gains were not widespread. 64% of stocks trading on the New York Stock Exchange declined an average of 28%. On the NASDAQ, 50% of stocks retreated an average of 32%. 1999 proved to be a very selective market. Groups like dot-coms, high-tech, or telecom did very well for a choice group of people, and if you didn't own a stock in those areas, you most likely did not love 1999. The technology sector dominated the market that year, and 1999 closed with Microsoft, the world's largest software company, having the largest market capitalization at $614 billion. That same year, Microsoft and Intel, the world's #1 chip maker, were added to the Dow Industrials. The reconfiguration of the blue chip index highlighted the importance of technology in the modern economy. It was further exemplified with the addition of internet issues like Yahoo and America Online to the S&P 500. Let's take a look back on some of the more popular stocks of 2019 and see how they compared in 1999. Apple's stock price was a mere $1.13. After breaking from a declining trend and consolidation zone at the beginning of the year, Apple's stock price practically tripled to end the year at $3.23. Still a bargain, I'd say. Apple is in a nice rising trend following the January gap down and price low. February, Apple was in a consolidation mode, moving mostly sideways, but it has since broken out. After a healthy pullback to $186, price appears ready to make a run past $197.50, which is currently Apple's high for 2019. I'd look for higher prices here. Amazon was at $85.50 on April 1st, 1999. It was a volatile year for Amazon, which was still mostly an upstart that hadn't ventured very far past online book sales. It finished the year lower at $76.12. Also still a bargain. Amazon had a great run in early January, but spent most of 2019 consolidating between $1,580 and $1,720. Since then, a nearly textbook flag has formed, and price is breaking out of it right now. I suspect we will see higher prices going into the spring and summer for Amazon. The minimum upside target of the flag formation would put Amazon at around $2,015. Cisco was trading at $21.72 on April 1st. A breakout into a new rising trend began, but it wasn't until November when the company's stock rose quickly. By the end of the year, it had nearly doubled to $42.34. Cisco has had a great run so far in 2019, coming off the January low, similar to a lot of other stocks. The rising trend is intact, and price has just broken out above resistance at $54. The MACD is turning up and could suggest this rising trend is just getting started. I would look for Cisco to move higher in 2019. April 1st, the Dow Jones Industrial Average was at 9,832.5 points. That month, the Dow hit new all-time highs as it soared past 10,000 points to reach the 11,000-point milestone. After a difficult correction from September to mid-October, the Dow corrected back down to test the waters below 10,000, but it left it behind and closed at a record for the year at 11,497 points. The Dow has spent most of March moving sideways. Best news is that what appeared to be a double top never was confirmed, and in fact, price turned right back around before testing what would have been the confirmation line at the March low. I always find that when you get a bearish pattern and then find a breakout from that bearish pattern, I usually consider that especially bullish. Resistance is weakening at that 26,200 level, so I would be looking for a breakout there. The S&P 500 was 1,293.72 points on April 1st. Volatile trading had the index swinging from a July high at 1420 down to a low around 1235 in October. However, by the time the year ended, the S&P had set new all-time highs and finished the year at just above 1,469 points. The S&P 500 has enjoyed a nice rising trend since the January low, although it has sputtered a few times along the way. The current breakout above the March 2019 high is very encouraging. Note the price breakout is arriving just after a positive crossover of the 50-day EMA above the 200-day EMA. This is also known as a golden cross, so it is an attention flag we should pay attention to. Volume on this breakout is healthy, and it does suggest that we will see some good follow-through to the upside going into the spring and summer. I hope you enjoyed our presentation of the 1999 stock market, but now it is time for the 10 in 10. Tom, I hope you're ready, because we do have quite a few requests today. And I was looking at the RRG, and I think that we have a pretty interesting setup here as far as our requests: technology, healthcare, and discretionary. Now, if you recall, we've been really heavy on the healthcare, but it looks like technology and discretionary are making comebacks. So let's go ahead and get started with Zions.
All right. First of all, it is in the banking space, as you can see from the name, Zion Bank Corp. And it got hit like the banks did in the second half of March when we took that tumble in the 10-year Treasury yield. You can see the volume picking up and the selling take place. We have bounced back from that, which is a good thing. We've gotten back up above the 20-day moving average. And you might want to watch that 20-day moving average to see if we maybe are starting something like we did when we broke above the 20 back in January. You can see we held above that 20-day for the next couple of months. And so as long as we stayed above the 20, it was fine. I do have some issues with the stock, and that is when you look at it well, first of all, when you look at the group relative to the S&P 500, it has been weak. When you look at the stock relative to the S&P, obviously it's been weak, because if it's a weak part, or even just an average part of the banking space, which I think it has been, especially if you just look back over the last 5 or 6 weeks, it's actually been a weaker part of banking, then you're going to have problems outperforming the S&P 500. So I think there are some issues here. A lot of support came in at about 48. As you can see, multiple tests at 48 before we finally broke down on increasing volume. Today's high was 47.93. So I think I think this is going to be a key area. This could be on, what is that segment that we have where we look at the pivots? This could be a really key pivot area for Zion, moving back up to this 48 level. So can we get through 48? Or do we roll back over and go back below the 20-day moving average? I think this is, if I was going to be in banks, I think that there were other banks that I would prefer over Zion. But if you're just interested in this stock, I would really watch that $48 level. We want to get back up through it, and we want to do it with some increasing volume.
Yes, and I think the segment you might have been thinking of was Turning Point.
Turning Point. Yep.
Yes. All right, most popular, we actually have a tie in the chat room, so we'll look at both. Applied Materials would be our first one, AMAT.
Love the breakout. Absolutely love this breakout today. It has been an underperformer within the semis. Look at Applied Materials relative to the semis. So if this is a stock that you want to feature as part of the semiconductor group, I would probably want to, well, not probably, I want to see this breakout. You can see this was a pretty key area of relative support. We started to bounce off of, we lost it. This would have been back in August of last year, and came back up. We tested it from underneath, pulled back. We're starting to show a little bit of relative strength again, which is good, but we got some work to do to break out versus the peers. So what this chart tells me is that on an absolute basis, I think Applied Materials looks much better. Clearly, we are breaking out above this double top. I think you can look at this as equal highs, higher lows, so a nice ascending triangle breakout off of an uptrend. But there are a lot of other semis still outperforming Applied Materials. So it looks good. I like it. But for now, anyway, there are probably other places within this group that I like better.
All right. The other one that was quite popular was ABBV.
Yeah, well, this one is within the biotechs. And the one thing I really want to watch here, and I'm watching closely, because biotechs are kind of like the semiconductors. When they get going, they can really move fast. And we've seen the semiconductors have a really nice start, and we're starting to accelerate to the upside. Biotechs have not been able to break out. They topped in mid-January and have not been able to get through that 2050 level. We're at 2034 right now. So if we can get that breakout, I'm going to be much more interested in these biotech stocks. Now, when you look at ABBV relative to the biotechs, this has been a stock that has really struggled on a relative basis. So I think, when I look at this, the relative performance, and I know the group hasn't broken out yet, I have no interest in ABBV at this point. It's been downtrending in an uptrending market. Don't like it. Could it turn? Sure. But until it does, I'm going to be looking for something else. So I would pass on this one and look elsewhere in biotechs. And to be honest, I'm kind of passing on biotechs in general until we get that breakout and start showing a little bit of relative strength in the group.
All right. Now, I think you talked about Micron earlier, but what about Intel, INTC?
Yeah, I went through a number of these semis, and they all look good. I mean, the problem with Intel is that it is hitting long-term price resistance now. So, and that's not necessarily a bad thing, but you might see some sellers coming in the near term. That's where we failed, $56 back in June. This is one of the bigger, obviously one of the bigger semiconductor stocks out there. So maybe for those who are a little more risk averse and want to be careful about getting into a small semiconductor, I think Intel is a perfect antidote to that. I mean, I think this is a great looking chart. I love the action here to the upside. Could use a little bit more volume, although I think by the end of the day we'll have some decent volume. But we've got to make this breakout. So in the short term, I'd probably take profits in Intel and maybe look for another semi. But longer term, I think once we pull back to either hit that 20-day or if we get the breakout, I think Intel's a great play in semis.
All righty. Let's see the next one up. How about Baidu?
All right, Baidu is in the internet space, and of course, internet stocks have really been outperforming of late. We are trying to get a breakout, but again, look at a relative chart, Baidu. So we haven't made an absolute breakout just yet. And on a relative basis, it's been a bad place to invest, to be honest. Here are your support tests to the downside. We broke down on increasing volume. And look at all the failures right at about 176. We're trading at 176.05. So I think Baidu's got some work to do. Now, if we get the breakout, it's going to be kind of like Applied Materials was in the semi space. Yes, it's an absolute breakout, but is it the stock that's going to give us the best performance in the internet space? Based on what I'm seeing here, the answer would be no. So until I start seeing relative strength within the group, even though it's making an absolute breakout, and you certainly could trade that, I would be really careful because it is an underperformer.
All righty, let's see. How about the insurance space, Progressive, PGR?
Yeah, well, the financials are starting to pick up for sure, and you can see that this is the peer group has performed pretty well, getting close to the high established back in September. So we want to take a look at that. But overall, I think this has been a really nice stock that's just consolidating a nice little flag right now. There is your peer group high. We're getting close to it. A breakout would certainly benefit this particular stock. Progressive, I believe, still has price support down to 71. You've got the rising 50-day coming up from underneath, and the recent highs up near 74. So I think we have a pretty tight range here, about $3. I'm going to see which way it breaks first, but if we pulled back and got back down to close to 71 and that 50-day moving average, I think the reward to risk there would be pretty good.
All righty, let's see. How about Fluidigm from the healthcare sector?
Love Fluidigm. That was my pick for this week. My setups, I own it. Fluidigm starting to make a little bit of a move here, up 2.25% today. I liked it off gap support in the 20-day moving average. And when you look at the relative charts, this is what I like. Medical equipment stocks rising versus the S&P. Fluidigm rising relative to the S&P. Fluidigm rising relative to the medical equipment. And medical equipment has made a breakout. And this stock has been a great performer in 2019 with super volume trends. So you're getting one of the best stocks, and you're getting it on a pullback down close to support. So that's why I liked it at the beginning of the week. But there's your gap support. Here's your 20-day test and the test of gap support. It's turning back up. I would look for it to go back up and test that $15 area. That's going to be a target of mine. If it gets up, 14.5, something like that, I might move to the sidelines. But that area is what I'd be looking for here on Fluidigm.
All righty, let's see. Next one up, Spirit Airlines, SAVE, S-A-V-E, of course.
Yeah, airlines really have had a jump this past week, as you can see, but SAVE has not gone along for the ride. It continues in its relative downtrend, which is kind of surprising because heading into January, this was one of the best stocks. And I remember talking about it, saying, hey, this was a nice-looking chart. And I thought when we got back down to about this 54 level, I thought that would be a great entry. But it has broken below that and trying to go back down to gap support. So here was the big move up on heavy volume, gapped up from about 51. And just a few days ago, you can see we did get down to that level. Previously, what I was looking for, and I could probably bring this down just a little bit. When we came down here, we closed at about $53.75, $54. So when we came back, I actually expected it was going to hold here. We went a little below, failed at the 20, came back down. We've been holding this level. I would say 51 to 54 is a key support area, and then clearly resistance is up near 65. The fact that we're getting back above the 20 is good, but I really want to see this relative strength line start to turn back up again. So if I'm in it, I would honor this stop because we do have a stock that is beginning to show relative weakness.
All righty, let's see the next one up. Fortinet, FTNT. Looks like it's getting back to the top of a trading zone.
Okay, yeah, I see a triple top here. Be nice to break out. You're in the software space, which has been a strong group. Fortinet was strong back in the early fourth quarter or maybe late third quarter, early the fourth quarter, and then really struggled in early November, as you can see the big drop. But it has begun to strengthen again. So on a relative basis, it's doing maybe a little bit better than average over the past 5 months. So they're better software stocks out there. As a result, if I was in it, I'd probably take my profits just because I'm at price resistance. And there's probably other software stocks that I can get into that maybe look a little bit better. But this is a range. Actually, I'd probably go all the way down to here. I think we're in a range from about $79 to about $88. Double top, though, that's where sellers have come in recently. Let's see if we can get through there. We have another one.
Yes, the last one is going to be a REIT, Apartment Investment, AIV.
It's interesting. I was looking at that stock earlier today because I was just looking at some of the REITs. I was writing about it in my blog. And so I went back into some of the individual stocks, and this was one that I had looked at. This is a really nice REIT. Look at the group relative to the S&P. It's been strong. The stock relative to the S&P has been strong. The stock relative to its peers has been strong. The group continues to move higher, and here's a stock that's going up with some pretty good volume trends. So I've got nothing negative to say. I'm not a huge trader of real estate stocks because many of them are dividend payers, and I'm more into capital appreciation. And I do think in a rising market, a lot of times we're going to be better off with some of the more aggressive areas of the market. But this has been a great performer. I can't really argue with this one. AIV, I think, looks good. Continuing to set new highs. I would just say maybe the rising 20-day moving average or maybe that prior price resistance, which is now support, down closer to $49 would make sense from an entry perspective if we look at reward to risk. So I think the stock looks good, though. Got no complaints here.
All right, excellent. That did complete the 10 in 10. I will get all of these symbols and charts up into the Market Watchers Live chart list right after the show. Just go to the articles blog tab and then click on the Market Watchers Live blog, and you'll see the link right there at the top. All right, I'll be back with the market update after this short message.
Join us April 1st to April 5th to celebrate our 20th anniversary here at StockCharts.com with special guests Arthur Hill, Greg Morris, Gatis Rose, Martin Pring, and John Murphy.
All right, it is time for our final market update. As you can see, markets are up right now, but does look like we might have hit an intraday high as we are starting to pull back. And we are seeing also that the NASDAQ, it looks like it's really making a little bit more of a forceful move to the upside after a nice gap up on the open. Mid caps and small caps are both higher for the day, and they're still near their highs. They're not pulling back in the same way that we're seeing some of the other major markets. Canadian markets, the TSX is up right now, but has fallen from an intraday high. The treasury yields are up on the day, moving mostly sideways now, currently reading 2.517%. Volatility index is on the rise, but we're still seeing readings well below 14 at 1358 right now. UUP gap down and continuing lower right now. The dollar is sliding. And you can see we also saw gold open down, but it is trying to make a bit of a comeback here, likely due to the falling dollar. USO, we can see, is moving sideways, but is down for the day. 6 cents currently at $12.95. TLT, big gap down and consolidating sideways. Been a very interesting week for TLT. All right, let's take a quick peek at the sectors, and I'm going to pass it back to Tom. Materials definitely the winner today, up 1.63% currently. But we're also seeing consumer discretionary and technology up 1% or more. Energy sector, the big loser, down 0.75%, and consumer staples, the only other loser on the day so far, down 0.25%. And that's all I have for my portion of the final market update. Go for it, Tom.
All right, energy. I'll just to kind of sum up what you were just saying there. You can see the energy group pulling back, and it hasn't broken out above the earlier highs that we saw a couple of weeks ago in mid-March, which is interesting because when we look over at the price of crude oil, Today, it's down a little bit, but you can see we had made a breakout above that mid-March high. And usually, here's the correlation between the crude oil prices and energy. And you can see it's pretty darn strong positive correlation. When crude oil prices are on the rise, normally we're going to see the XLE rising with it. There have been a couple instances of negative correlation, inverse correlation, but for the most part, we see mostly positive correlation. So I would suspect we're going to bounce off of this 20-day moving average, and I would suspect that we're going to see a breakout pretty soon to the upside in energy, given the direction of crude oil prices. So let's go ahead and move into our final segment. We do have a poll running, and ran a scan earlier today talking about the high volume stocks, some of the stocks that are that are trading well above their normal trading volume for a day. And so we highlighted 5 of those on the poll. We just wanted you all to take a look at it and come up with what you thought. You know, are they technically sound companies? Just because they have volume doesn't mean they're technically sound. And so Erin and I are going to go quickly through and tell you what we think of those 5 stocks. Go ahead, Erin.
All right. Yes, and it will be quick. All right. So I will give you the hint that 3 of the 5 I felt were technically sound. And the first one I'm going to look at is Elf Beauty. And you can see a really strong, powerful breakout today on that heavy volume. What I like is, you know, you're continuing that move to the upside. You can see that the bottom of the PMO range is around -10, and our PMO reading is only at 6.67. So there is still room to run, and I don't see serious overhead resistance until we get to 14, which comes right there with these tops back here. And then if you want to go to the gap resistance line, you can see that at 1450. And then if you want to go to the top and the low here, this is going to be a tough resistance zone, I think, for ELF. But you know what? I think they can at least get there. Let's see. The next one I have is Dave & Buster's. I think this one is looking good. We're getting a breakout from a trading channel. And I've got a PMO buy signal coming in on this. Look at the volume coming out on these moves to the upside. And Scooter is improving nicely. Hard to say too much bad about this, except maybe you might be facing resistance just above $55, where you can see that top back in June and the October low. And the other one that I liked was, and I think this was an obvious play, AMD. Semiconductors having a great day, but really, you know, AMD and a lot of the semis have been rising now for quite some time. And I like the PMO buy signal here. I like the improvement coming in on the volume coming off of this bounce off the 20-day EMA. You know, you opened just almost above that short-term top, and we're trading well above it. I would look for a move at least up to that $34 level. And the 2 I did not like were, let's see, Altaba. And I wanted to like it because it reminded me of one of my favorite bands, ABBA, but I can't say that I do. There's a couple of problems here, which is why I just put it on the unsound side. And the main problem is the Scooter is moving lower. PMO is moving lower on a sell signal. You know, we're not getting much out of that OBV. It's moving sideways. We do have on the plus side a symmetrical triangle. They typically are continuation patterns, which suggests a breakout to the upside. But there are other problems here, so I didn't consider that one's technically sound, so to speak. And then finally, Tellurian, I didn't like. Mainly, you know, we didn't even get up here to test that $12. You know, it didn't even go up there and touch it. And then past that, of course, is the $12.50 level, not even close. And now it's been turned back down. You've got the PMO is topped. You know, on the bright side, during this rally, we did see the right kind of volume, but it looks like it's tired and ready to fall. So I voted a thumbs down on Tellurian. So what are you thinking, Tom?
All right, I will try to go through these pretty quick. ELF, I did not like. Looking at it on a relative basis, you can see its peer group had already broken out above these tops, and you can see the stock has been declining for quite some time, possibly getting a black candle today off of an uptrend, which I don't like. It's starting to show a little bit of relative strength. So the one thing that I would say is that if I was in it, if it lost the 20-day moving average, I would be out of it. But I would say overall, because it has been such a poor relative performer in a group that has broken out, I would say no, I don't like this one. Play is another one that I'm not a big fan of. It did gap up. I think it's got work to do to get through $54. I like the volume coming in, but this has been in a very strong group for the last 6 months, and the stock has been going down. Now, if we can get through $54, I think that could be a potential character change, so I'd certainly be interested in that, but we're not there yet. AABA, I do like. I like the move up. I like the sideways consolidation. I was looking at it as more of a flag, but I can certainly see the symmetrical triangle that Erin talked about. The internet stocks have been performing very well in 2019. We've seen relative strength in the group in 2019. And I think overall, this is a stock that's been performing pretty good relative to the group. So I think as long as it holds the recent breakout at about $70, I'm okay here. TEL, I like, but I recognize it's not in a great group. You can see in the exploration and production area, this area, we haven't gotten a breakout yet. On a relative basis, this group's been very poor, but TELL has been one of the best performers within the group and still looks okay technically. In fact, I love this test of 1050 and the 20-day moving average. So this is one, because it's in a bad space, I would have wouldn't try to make any excuses for it. I would be following 1050. A close below that level, I'd be concerned, but for now, I'm okay. And then finally, AMD, love it. Love this one. I think the semis are strong. You can see that the relative strength in the group versus the S&P looks good. And AMD is just making a breakout relative to its peers. Look at the volume coming in on this move. I think we're heading up to challenge that $34 level. Love AMD. That's my favorite of the 5.
Yeah, I have to say, I agree.
Yeah, we'll pull up the poll and see. Everybody agreed with us on AMD for sure.
Yes.
And they agreed with you with 2 and 3. I did not like 2 and 3, Play and ELF, but I do like the bottom 2.
Yeah, I mean, the main one was I just had one bad thing on the last 2. So why, I mean, the other 3 didn't have bad things, in my opinion. So at least for my analysis. So yeah, I think that's interesting.
I use the relative strength quite a bit. And TEL, the one thing I didn't like is it is part of that exploration and production group, but it has been a really good performer in a bad space. So, if the group turns around and starts moving higher, you got to believe more money is going to rotate into that one. And if it doesn't, if the stock breaks down, then you've got a bad group, and certainly something that we should be monitoring and be mindful of, because I don't like holding stocks that break down in a group that's not been strong.
Absolutely.
Okay, well, we got about a minute left here, and I got to say, we still got a pretty good day going on. Dow Jones currently up 73 points, NASDAQ 73 as well. Of course, on the NASDAQ, because it's a much smaller index value, that is a much higher percentage, up near 1%. So we're seeing leadership again from the NASDAQ, a little bit from the Russell 2000. So I view that somewhat bullishly.
I have to agree with you. It's looking a lot better than it did. It's, earlier in the week, it seemed so soft to me. And now I don't know, things are feeling a lot more bullish.
Yeah, I think, some of the key sectors, I think are starting to move. And another way you can look at that is if we go over here to the sector summary and then go year to date, because essentially that's when the market started running. And you can see technology and industrials leading to the upside, discretionary, communication services right there as well. So very, very good action, I would say, in the market. Okay, well, hopefully everybody is enjoying this special week that we have for you here at StockCharts, our 20th anniversary week. We will be continuing that in the next couple of days, couple of great guests. I want to thank all of you for being with us today, especially Gatis Rose for joining us. Appreciate Gatis coming on. Please remember to complete the survey as you exit. As a quick reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great Wednesday afternoon, everybody. We'll see you back here tomorrow. Happy trading.